Retirement is a huge deal, right? For most people, having enough money to comfortably retire is a top priority. But figuring out how to actually live off your savings once you stop working can be tricky. The standard advice is to spend a mix of investment gains and interest from bonds each year. But what if you could get consistent income from your portfolio without having to sell off shares? That's where dividends come in handy. Dividend-paying stocks and funds can provide regular cash flow to supplement Social Security and pensions. With the right planning, dividends could even cover all your retirement expenses so you don't have to sell any assets. Wouldn't that be amazing? Let me explain how it works. Dividends have a key advantage over bonds when it comes to retirement income planning. While bonds provide fixed interest payments, stock dividends typically grow over time. And get this, dividend growth has actually outpaced inflation historically. This means dividends maintain their purchasing power better than interest. For investors with long time horizons, that growth can be used to create portfolios that generate enough income to fully retire on. Let me walk through a quick example to demonstrate the power of compounding dividends. Imagine you invested $100,000 to purchase 1,000 shares of ABC stock at $100 per share. Now let's assume ABC stock has a dividend yield of 3%. That means each share would pay out $3 in dividends annually. So your total dividend income in year one would be 1,000 shares multiplies $3 per share equals to $3,000. Now here's where the power of reinvesting comes in. You take those $3,000 of dividends and use them to buy more shares of stock ABC. For simplicity, let's say the stock price stays at $100 per share. By reinvesting your dividends, you could buy another 30 shares. So now your total investment in ABC stock is 1,030 shares bought for $103,000. By reinvesting dividends to accumulate more shares, you've compounded your future income potential. Those 1,030 shares would throw off $3,090 in dividends the next year. And after 10 years, your dividends could surpass $7,000 annually. And in 20 years, you'd earn over $24,000 per year in dividends alone on your original $100,000 investment. Pretty awesome, right? Of course, this works best if you're still in the accumulation phase. But even for near retirees, focusing on dividend growth and higher yields can provide sustainable income. For immediate income needs, high-yield stocks like REITs and MLPs are great. They may not grow dividends much, but they have 6 to 10% current yields. This boosts your portfolio income without selling assets. You shouldn't abandon dividend growth stocks either. Companies like Procter & Gamble raise their payouts consistently. This compounds income over time and hedges against inflation. Blending high yield and dividend growth is powerful. Building a diverse portfolio yourself is hard work. Dividend ETFs make it much easier. They instantly give you exposure to many dividend stocks. Some focus on dividend growth, stocks likely to raise payouts over time. Others target high dividend yields for income now. With ETFs, you can simplify income planning. Living completely on dividends takes planning upfront, but reinvesting dividends for many years can create lasting streams of increasing cash. Even smaller dividend portfolios generate steady money to lessen withdrawals. So don't overlook how important dividends can be in retirement. They provide regular income that can fund a significant portion of your lifestyle. So there you have it. Let me know if you have any other questions. And if you found this helpful, please give the video a thumbs up and subscribe. I'll see you in the next one.